How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss in full detail what is an annuity account and how might an annuity benefit your specific situation, and then also how might it be a detriment to your exact situation. The first thing to understand regarding annuities are annuities can only be offered through insurance companies. So if like somebody goes to a bank and a bank's offering an annuity contract, well, they're offering that through an insurance company. Just like insurance companies cannot offer bank CDs or bank-related products, banks cannot offer insurance-related contracts such as an annuity. To make matters a little bit crazier, annuity contracts, you have about 1,200 plus different options available in an individual situation in their particular state at a given time. So you might have something known as an immediate annuity, you might have a fixed annuity, you might have a fixed index annuity, a variable annuity, a hybrid annuity, deferred income annuity. There's all these different types of annuity contracts. And what exactly, if you're hearing all these different things, good things about annuities, horrible things about annuities, which advice should you really take? So I want to take a step back and explain how things were to, why are annuities now being more and more attractive, and then how to really, siphon through the BS that you might be hearing from an insurance agent or from an advisor that's offering this type of product. And retirement planning and investing used to be very simple. An individual was able to go invest their monies into their 401k, their employer-sponsored retirement plans, or set up brokerage accounts, and throw those monies and mainly set up low-cost options that were invested into the stock market. So if you kind of think of your retirement plans as a bucket, it's as if someone's contributing to this plan, and then also they're getting this bucket is being maximized because there's a specific percentage rate of return that is linked to that bucket. So from 1980s through 2000, you had over 1,000% growth in the stock market. So it was really simple. You had advisors that looked like gurus because they were saying, "Oh, invest with me, and we're going to make some money for you." And these clients were having really large growth into those accounts, and the advisor was just essentially targeting the upward stock market trend to have those gains hit those accounts. If somebody was investing their money on their own, well, then they were just investing it on maybe a lower cost option, same sort of result that they were capturing this nice 1,000% growth within the market. So when it came to retirement planning, you had two main options. You have something known as the 4% rule, the Prudimans rule. You had the other one, which was known as a laddering strategy, with which path that retiree, that senior, was looking to take. So what I mean by that is if they're receiving growth into the market, everything that they're placing into their retirement accounts is going up with the contributions plus whatever that rate of return is positive. And then now they're looking and they're saying, okay, I have this large lump sum of money. I want to start pulling out these monies. Well, you had financial advisors that would typically recommend something known as the 4% rule, which says if you stay invested, there's about a 90% chance that if you're pulling out 4% per year of your monies, that you should not outlive your retirement dollars. Now, this 4% rule was very popular before you had a lot of this volatility that occurred, but understand that if somebody had $1 million in their buckets, in their retirement accounts, they could say, okay, I could siphon out comfortably $40,000 from my monies, and there's about a 90% chance that I'm not going to outlive these monies. Well, this rule has really been disproved in more recent times, especially from the lost decade from 2001 to 2011, when you had volatility. You have something known as reverse dollar cost averaging that disproves this 4% rule, which even showing 4% of your retirement account is very small amounts to live off of. If you want to really maximize those monies, you could leverage an annuity contract that will provide you lifetime income. The other aspect, and I'll get into exactly what I mean by that, but the other aspect, when somebody was more conservative, they might say, okay, I have $1 million that's now sitting there that I've accumulated during my growth years. Now I'm looking to be a little bit more conservative and start pulling out monies for retirement. I'm going to go and use this $1 million, and I'm going to set them up in bank CDs and fixed annuity laddering strategies to receive lifetime income. So what you had regarding bank CDs and fixed annuities was from the 1980s and 90s, you had very large interest rates. So you could have a bank CD, like a 5-year bank CD, that's paying 10% at that time, with a 5-year fixed annuity that's paying about 12% at that time. So what somebody would be able to do is say, okay, I could go and put my $1 million into a bank CD, receive 10%, $100,000 of interest, live off the interest for that year, collect that for 5 years, and then I'd still have my $1 million that's sitting there that I could therefore just re-roll out into a 5-year product. Some individuals didn't like to put that much money into an individual bank CD or a fixed annuity, so what they would do is set up a laddering strategy where they say, okay, I'm going to set up a 5-year, a 4-year, a 3-year, a 2-year, and a 1-year bank CD or fixed annuity. That maybe that 5 years paying 10%, 4 years paying 8%, 3 years paying 6%, 2 years paying a 5%, 1 year's paying a 4%. And what they do is they splice up portions. Maybe they take $500,000 out of their $1 million. They purchase a $100,000 5-year, $100,000 4-year, et cetera, so that after every 1-year point that occurs, they'll take $100,000 and purchase a new 5-year bank CD, so that eventually after 5 years they're having 10% off of their $500,000 of money while still having liquid cash available for them. So that was a very popular concept, and that was a very popular retirement technique when markets were doing well and interest rates were high. Well, unfortunately, there has been a very large shift that does not allow these two forms to be successful anymore regarding retirement planning. So if we use the 4% rule as an example, let's say that we have that individual that has $1 million of their retirement accounts. And understand, if you only have 100,000 or 200 or 500,000, just understand I'm trying to make this just a hypothetical, very easy example. What happens with this 4% rule is they didn't incorporate something known as reverse dollar cost averaging. What that says is those advisors that would set up those accumulation phases and try to give them that financial advice, they'd be charging very high fees with these accounts. Typically, these advisors would go and place the individuals into mutual funds, which is a blend of stocks and bonds, which are very expensive. On average, right around 1.5%, we'll call it 1.25% of a mutual fund related fee on that account each and every year. That's just what it costs to have their money invested in those funds. On top of it, the advisor would be charging another 1.5% advisor fee to monitor that account and to try to give their best recommendations. So from the advisor's standpoint, they're getting a commission when they're placing in their mutual fund dollars, when they're placing in those clients' monies on the mutual fund, and then on top of it, they're getting a constant commission each and every year that individual's staying put within that account as an advisor fee. So if we go and let's just say that the mutual fund related fee was 1% and the advisor fee was 1%, but we now have to poke 2 holes in the bottom of this bucket. When you're looking at a very large account, that's $10,000 and $10,000. That's $20,000 that's coming out of your account by just sitting in those funds. The next negative is a downward market loss potential. In 2008, you had average portfolios lost anywhere between 30 to 60% on average. Let's say you take a large hit, you take a minus 50% hit. That's half of your retirement portfolio, and on top of it, you're paying your mutual fund related fees and you're paying your advisor fees to pour more salt in the wound. So let's say if you have a minus 10% loss in a given year, and just a very realistic example, and you're paying 1% in mutual fund related fees, 1% in advisor fees, a 10% loss, and let's just say that you have the $1 million, that's minus $100,000 in the downward market loss because there's no safety net there. You have $10,000 of a fee, $10,000 of a fee. Right already before you start pulling out any monies, you're $120,000 in the hole. Then you need income to live off of, so let's take out that 4% rule, or let's take out $40,000 that was supposed to be established if you leave your money invested with these accounts. So now we're down minus $160,000 in the hole off of that $1 million that you originally had that year. So now when you're walking into the year for the next year, you're sitting at $840,000. When you're pulling out $40,000 in year 2, that's going to be a higher percentage. So this percentage is going to be increased. These percentages are going to remain the same, and you're still susceptible to downward market losses. So even when you have a gain, you still have an uphill battle struggle because you have this power of compound interest that's working against your retirement accounts each and every year or each and every month that you're staying put within this specific strategy. And that is what has led to retirement disaster. That's what's led to seniors and retirees and baby boomers not being able to properly retire. You have technological advances that keep increasing the longevity of somebody living, and you have these negatives, this reverse dollar cost averaging negative that is being associated with the account. So the longer that this person's living, the more inflationary risk that they have, the more longevity risk they have, the more monies that they have to pull out, and they still have these negatives sitting there with no safety net. So this is why individuals are not able, the majority of individuals are not able to properly retire, is because they're going with the status quo approach. A very simple solution to combat that 4% rule is by establishing an annuity account or annuity contract with income riders to provide lifetime income. What an annuity contract is and why it's offered through an insurance company is it's the complete opposite of life insurance. So what life insurance does is it prevents an individual from dying too soon and will provide a lump sum benefit to the beneficiaries in case that person was to pass away during a set duration of time. An annuity contract prevents an individual from living too long. So an individual is going to take a lump sum dollar amount. This annuity account can either be established through qualified retirement account like a 401k rollover into a traditional IRA, an IRA transfer into an IRA annuity, a 403b into a IRA annuity. You have 457 plans, thrift savings plans that could be rolled over into an IRA annuity. And if you're looking mainly as a max income play, well, you could leverage these types of insurance-based contracts that state, okay, I'm 60 years old right now. I want to retire when I'm 65 years old, or whatever your case may be, and you could designate specific dollars to that annuity that states if you need $40,000 of income for the rest of your life, well, out of that $1 million, you don't have to be susceptible to that reverse dollar cost averaging effect. You don't have to pay mutual fund related fees. You don't have to pay advisor fees. You don't have downward market losses that could hinder those accounts. And out of that $1 million, maybe it might only use $600,000 to provide that same $40,000 benefit with that 5-year deferral. So you could be confident saying, okay, by the time I'm age 65, I have my money that's growing with that specific annuity account. When I hit age 65, I now have exactly $40,000 of income for myself or me and my spouse that we could never outlive. If, let's say, this person was to pass away within the first couple of years, whatever is remaining in their account value would be left to beneficiaries. So they're still able to control their monies. Let's say if they keep living and living and living, they're living into their 70s, their 80s, their 100s, well, your 401k account, your 403b, your retirement accounts, that 4% rule would have completely gone by the wayside. You would have outlived those monies. The insurance company with these annuity accounts are still on the hook to provide you that lifetime income. So you're hedging your bet. You're basically leveraging this type of contract for an insurance that you will not outlive that specific dollar amount. So understand that's a very simple version of a hybrid annuity. It's a fixed index annuity with an income rider, and it provides that individual peace of mind that if they go and they place X amount of thousands of dollars into those accounts, they could receive guaranteed lifetime income by the claims paying ability of the insurance company that they can never outlive. So when it comes time for retirement planning, one of the most important aspects is income. That's probably the most important aspect is income, because if you don't have the income sources, how are you going to pay for your expenses? And now you're just going to be subject to probably relying only on Social Security. And this is why majority of individuals rely solely on Social Security, is because they burn through all their retirement dollars, falling victim to that reverse dollar cost averaging effect. They could leverage an annuity contract, the best annuity contract in their area, to make sure that they're sufficing and they're accomplishing those specific goals. Now, as I talk about that really simple example, understand that's not just that easy to get to. You have a lot of, excuse my language, bullshit out there regarding annuity contracts, and you have a lot of bait and switch techniques with these insurance companies that you might have company A that says, yeah, if you go and you give us X amount of thousands of dollars, we'll provide you $40,000 of income in that example at your age 65. Well, maybe with company A, it's going to require that you give them $850,000, as opposed to finding the best company, let's call it company B, maybe that's only going to require $600,000. So you're able to save hundreds of thousands of dollars of more benefit, of more value in your pocket at the end of the day, at the end of the year, than falling victim to just the marketing trap that a lot of these insurance companies try to provide. So when I'm talking about there's 1,200 plus different contracts out there, understand that you want to make sure that it's navigated precise to what your age is, what your exact retirement goal is, to make sure that you could leverage that as an income play. The other side that I spoke about was the laddering strategy, which individuals used to use with fixed annuities and bank CDs to say that interest rates were, paying 10% for a 5-year bank CD. Well, now you have interest rates are hitting all-time lows. You'd be lucky if you get a bank CD for a little over 1%, and therefore it's completely flopped how individuals can properly retire. So that's why they have to look for other alternatives. They could go the alternative with taking those dollars, saying, okay, well, obviously we can't use the laddering strategy because it's paying us such a small rate of return, so we can't use that fixed strategy. We now have to take on a little bit more risk. Well, could fall them victim to that 4% rule, or they could go and place their safe dollars, the smallest amount of dollars out of their retirement accounts, and only as much as necessary to accomplish what their income goal is. To make sure that they're combating inflation, make sure that they're combating those negatives, that reverse dollar cost averaging effect that you would get if you invested your monies just strictly in the stock market and strictly with just that managed money type approach. A different way on how somebody could leverage an annuity account is by not looking at it as an income play, but mainly looking at it as a safe accumulation play. The reason why people go into bank products is because they want to feel safe, secure, that their money is not going anywhere. Well, insurance companies offer that same sort of feature through annuities, through fixed annuities, and also fixed index annuities without income riders, so just very generic contracts that are going to give you specific gains. So if we're looking at a bank CD, and we understand that a bank CD is going to be, let's say, pay 1% for a 5-year bank CD. If someone puts in $100,000 and that bank CD is paying 1%, well, then they're going to get $1,000 the first year, $1,000 the second year, et cetera, et cetera. After 5 years, they would have received $5,000 of interest, and then would be able to pull their $100,000 back out and kind of re-roll that over into a new, bank CD or whatever they want to do. Just take their money and walk away. A fixed annuity, in particular a MYGA, usually pays about 2 to 3% higher than a bank CD. So like right now, the best fixed annuities are paying a little north of 3%. So what that tells us is that you could live off of that interest of $3,000 with the $100,000 example each and every year. And then after those 5 years are suffice, you could take the $100,000 and take the money and walk away. Very similar concept. One is offered through an insurance company, the other is offered through a bank. Both have something known as a legal reserve structure of safety, making sure those contracts are very, very safe. The fixed index annuity has been gaining a lot of popularity more recently is because interest rates have stayed at all-time lows. They've been staying very low. And somebody says that, or somebody realizes that if they leave their money at this very small interest rate, this 1, 2, 3%, well, inflation is increasing between 2 to 4% on average in a given year. That's about rule of thumb is in between 2 to 4%. So that's the cost of goods and services. So if you're going and taking your dollars and just throwing into a checking account, throwing into a savings account, throwing into a bank CD or a fixed annuity, and you're barely getting any interest credit on there, well, then you could be losing to that inflation risk. You could be losing to your purchasing power risk of saying that your dollar today is not going to be as powerful as a dollar 5, 10, 15 years from today. So a way that how individuals have flocked to this FIA, this fixed index annuity, is you have to think of that like a bucket with the lid over it, and it's tied to upward market stock market indexes that you will receive a gain when the market goes up and receive 0% floor when the market goes down. So with proper FIA contracts, it could range anywhere from, on the low end, about 6 years, high end, about 10-year contracts. You're not attaching, there's no fees, there's no mutual fund related fee, there's no advisor fee associated with that, and it usually gives you a better rate of return than how fixed accounts are currently being paid. So on the low end, you could expect about a 3% rate of return per year, and on the high end, about a 6, 7, sometimes 8% rate of return per year, depending upon the carrier, depending upon the contract you're being invested into. So that provides the opportunity to an individual to receive upward market gains without that downward market loss that could hinder retirement accounts. So if somebody's nearing their retirement, they say, okay, I understand I have a portion of money, maybe I have Social Security income, maybe I have pension income, and those two income streams are now, they're sufficing what my expenses are. I don't need to utilize an annuity for income, but I want to put a portion of my dollars into an annuity for safety. well, then that's where an annuity or an annuity account could really work out for that individual situation. They could go into the managed money route, and there's certain things that we do. We do a tactical money management, but there's another way that you could just say, I don't want to pay any fees. I still want to have those nice gains, nice consistent gains each and every year, and allow my accounts to to benefit in that power of compound interest working in a positive direction. And that's where the FIAs come into play. But once again, just like the income accounts, just like those 1,200 different scenarios, you have majority of FIA contracts are garbage. Majority of FIA contracts leverage the client for the benefit of the company, but there are some sweet spots with annuity contracts, and that's something that my agency has been very successful in finding out, is saying, depend upon the individual situation, depend upon where they are right now, point A, depend upon what they want to, where they want to go, what they want to accomplish to point B, how to get there successfully. Does an annuity account make sense? Does a specifically designed annuity contract make sense for that particular area, for that particular age? Or should you avoid annuities at all costs? Should you just stay put to what you're currently doing, and you could get to your destination successfully? So what we try to do is we utilize a lot of systems. We take a more of a scientific approach. We try to make sure that the results are to the decimal point so that you do not have any worry when it comes time for retirement. With retirement, you only have one chance to get things done correctly. It's worth it to look at your options, to become educated, and that's what we try to do. We try to send you, when you call over to our agency, we're available 24 hours a day, 7 days a week, morning, nights, weekends, holidays, whatever the case may be. And when calling over, you're going to talk to an assistant. You'll tell them that you saw a video on an annuity account. You might be interested in some information that you want to speak to a specialist. That assistant is going to patch you over to a specialist, and that specialist is going to ask you a slew of questions. Depending upon your answers, they're going to send you over literature pieces, personalized videos to really help out getting you acclimated to how to understand this retirement process and make sure that you are setting up your retirement successfully. We're A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. I believe it is because of this methodical process. Usually when we have clients like to stay with us is because we want them to be educated, we want them to be in the know, and we want to make sure that they're comfortable and we're holding their hand every step of the way, for just pure value, as much value as we could possibly bring. I want to thank you very much for watching this video. Please feel free to subscribe to my YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys, and we look forward to taking your call.